Hello, this is Mike, your legacy wealth coach, back here today for a special presentation. Today, I want to share with you how, yes, you can be the bank. And now, this will take quite a bit of thinking, and more important, I will challenge you to rethink your thinking, just as the slide says. So, what does that mean that you can be the bank, and why would you even want to do that? Well, all right. First, this is our little mission and disclaimer. I totally believe, and I mean, that's the point of this channel, that education and knowledge is power. To your right, you see this book, Becoming Your Own Banker. This is the seminal book by Nelson Nash that really kind of solidified this concept, and it's kind of like the Bible of IBC. So first, we're going to go over what is banking. All right, why is it important? What is a cash flow system? Because that's really all banking is, as we'll see in a minute. And what is IBC? It's not irritable bowel condition. It's infinite banking concept. And most importantly, how can I use it, or how can it help me? The point of this is for collaboration and inspiration. We'll be sharing ideas just across this channel, and I offer to challenge your thinking. Um, this is for networking, fellowship, idea generation, encouragement, and support. But we are not giving away any legal, tax, accounting, or investment advice. Have to get that out of the way. Now, let's go on to the fun stuff. Your why, okay? What brought you here today? Um, think about that, right? You, you could be doing other things, but why are you here? What do you think is the biggest financial challenge for people today? And what are you hoping to find out? And why is this important for you? Okay. Always keep that in mind when you continue to learn. It'll keep you motivated to understand things to benefit you and your family. Okay. When the why is big enough, the how is easy. All right. Very good. Now, let's talk about this bank. It's not what you think. All right. Most people know, yeah, what's a bank? Well, first and foremost, it's a business. And to be honest, financially, it's one of the best. What do banks do? Well, they make money, they make lots of it. The really interesting thing is how they make money. Okay. Maybe not so great for you, but believe it or not, it's with your money that they make money for themselves through savings and loans. Okay. Note that money never needs time off. It never complains, never gets sick. Okay. If you own a business and have employees, you know how that is, right? Your employers, um, they need time off, want vacation, they want raises, they complain, they get sick, or don't show up for work. Your money never does that. Okay. How do banks do it? Well, with an example, they have savings accounts. They'll take your money, right? Give you a little bit of interest, and then they turn around and loan out your money, actually more than what you put in, and loan it out in mortgages, business and auto loans, etc. And guess what? They loan it out for a higher rate than what they pay you. Believe me, they profit off the spread. And that's what we're talking about, right? 4% on average for these mortgages and various consumer loans that they'll charge you for. But when you put your savings account in there, they'll pay you a whopping 0.01%. Okay. I don't know about you, but that's 400 times more that they charge you than they pay you for the use of your money. Bottom line here, always remember this. You want to be in two businesses: the business that makes you money every day, or whatever your business already is, and the banking business. People don't know this, but they can have both going at the same time. And that's the point of this talk, right? Be the bank. Now, let's take a look at the typical consumer and how what's going on for them. Most people, Americans today, live paycheck to paycheck. Nearly 40% of them cannot cover a surprise $400 expense. We listen to conventional financial advice, all those gurus and experts that say buy term and invest the difference. By term, they're talking about life insurance, right? It's super cheap and it's limited in duration. Then the idea is that the savings that you have from buying term, you invest that into the market or whatever vehicle, that you can get a return on. The average savings rate is just 10% each month. And I say 10%, to be honest, pretty optimistically. Most people don't even save that much. But for the purpose of our example later, we'll say it's 10%. And what do? Well, we hand over control of our money to the experts, right? These people with these fancy degrees, and you know they're running your money and investing it into mutual funds, IRAs, 401ks. Okay, these are often tax deferred. Okay, which just means that you're not taxed now on that money, but you're taxed later on the harvest of it. Okay, which is actually, if it's a lot more at that time, you'll actually be taxed more. Yay! And then what's the biggest expense that most people pay every year? To be honest, it's interest and taxes there. See at the bottom, the average total comes out to about 34.5%. Now we're talking about payments that you make to your car for housing, mortgages, um, automobile financing, for schooling, tuition, medical bills, etc. Okay, 34.5%. And you see that little guy on the right running on that hamster wheel. That's how most people's financial, situation feels. But let's see what the average annual pattern of spending is. And look at this at a percent spent per month. The graph here shows that the green is the principal, the blue is the interest. Average is about 35%, and we'll see how. At the left, you see autos. Okay, 20% of that expense of your monthly take home on average, again, goes to paying for your cars. And you notice that blue line next to it at about 5% is the finance charge, right? For these car notes that we have. For housing, it's even worse, okay? On average, people spend about 30% of their take home pay to the rent or to the mortgage. And then of that mortgage, right, there's about 25% of that going to interest. Now, you may be thinking, wait, but my mortgage is only 4%. Actually, because it's amortized, take a look at your last um, mortgage statement. I challenge you. If it's less than 5 years old, that mortgage is going to be costing you way more than that 4%. If you're paying $800 to your mortgage, at least 400 of that is going to interest. Believe me, check it out yourself. And then living, the third column there, about 40% of your money goes towards, food, clothing, entertainment, and there about 5% of it is interest. Okay, we're talking sales tax typically. In here in Texas, I mean, it's way more than 5%. I think it's closer to 8%. And then savings on the very right, that's that 10%, optimistic 10% there. So let's break this down. The blue again is the interest. The average, if you add up the 5, the 25, and the 5%, is 35%. That 35% interest you're paying when you're, remember, only saving about 10%. And if you take that 10% and liken it to an airplane flying at 100 miles per hour, well, that drag of 35% taxes is like a headwind of 350 miles per hour that we keep flying into and against. The bottom line is that we never really get ahead financially. And you don't have to look far to kind of know that that's a fact for most people. But is there a better way? Well, actually, there is. And let's continue. But first, we have to look at what the problem is in a nutshell. All right. Think of your money as water, right? Water is great. It's the lifeblood of all things. Your money's the same way, right? It has to flow. And it flows into this bucket or your cash flow system. Everyone has one, whether they know it or not. Okay, maybe it's just your wallet and that little savings account at the bank, but that's it. That's your cash flow system. So what do we normally do in this scenario? Okay, you drip, you're flowing water into your bucket or cash flow system. You try to turn up that faucet for a better or faster flow, right? You get that extra promotion, you get that, extra um, job. Okay, maybe you buy some CDs at the bank. Remember, they're paying about 1.5%, 2%. Or you can invest it in the stock market, right? Go wild, go long on Apple and hope for the best. Some people invest in real estate or they'll, sell stuff on eBay or Etsy if they're handy or crafty. Think of what's the craziest thing you've ever done. We've all done it, right? We're always trying to make that extra buck. That's what most people do, though. They focus on the flow into that bucket, never realizing, however, the problem isn't in the flow, it's in missing and ignoring all the holes in your cash flow system, in your bucket. Okay, we're talking all the interest payments that you're paying, all the taxes and the opportunity costs of that money that's left and never coming back to earn any more money. Okay, that is that's what we're talking about. This cash flow system is flawed, it's broken. We have to fix it. So let's see how is that done. First, I want you to imagine the perfect vehicle. I'm a car guy, so I love that AMG, Mercedes there. But we have a few very important characteristics of this perfect financial vehicle, right? First of all, it's got to have a good rate of return. And that means that it's steady, reliable, it's compounding, right? Also, it's very liquid. It's easy to use and to reuse, right? If my money is locked up in a CD for 12 months or 24 months, I can't use it, all right? It's sitting there growing, sure, but I can't use it again. The perfect vehicle in my mind would allow you to pull out your money to use at any time and it's still growing. How would you like that? Also, it's tax advantaged, okay? Which means it's not taxed like your income is, right? Where every dollar that you make, you got to set aside 20 cents, 25 cents, some 30 cents, right, for income tax. Also, it's not safe, right? Well, I mean, it is safe. The perfect vehicle, right? It's safe. It's not tied to or dependent upon the market. Market's been going well, sure, for the past few years, but just like a roller coaster, what goes up inevitably will come down. So think about that. Also, in my opinion, the perfect vehicle is private. That means it's on a contractual basis, all right? And being private, it's not reported to credit agencies. You don't have to, you know, depend on your FICO score or, threaten getting, a bad credit rating, if you default on something. More importantly, it's because of private, there's no threat of government intervention, right? Right now, the rules may be favorable for some of these, retirement accounts, but believe me, the government could at any time, because they're not private, decide to change the tax basis or the tax advantage on these vehicles. So the perfect vehicle, however, is immune from all of that. All right. So you may be thinking, wow, that sounds great. I mean, shoot, if there was something that had all of this, I'd definitely take a look. Well, actually, there is, and you might be very surprised at what that is. Okay. Whole life insurance. Ta-da. Pretty boring. I mean, it's vanilla stuff, but it's been around for hundreds of years. But first, let's understand what it is, because a lot of people, they don't understand, okay, or they hear all the static on the, gurus kind of trouncing on it. The definition, according to Investopedia, is that whole life insurance is a contract that provides coverage for the life of the insured and offers a savings component for the accumulation or growth of the cash value. All right, so there's two parts here, right? It's a contract that provides coverage and has a savings component. All right, so that's three things. I lied. But let's look at some terminology that's important to know. Okay, with whole life insurance, there's regular premiums. What does that mean? Premiums are simply the payments that are paid to the insurance company to guarantee your coverage at the point of your death. Okay, but it being regular means that it's guaranteed never to increase, and that's a big deal. Okay, if it's 200, 200 a month now, or 2,000 a year now, in 20, 30, 40 years, if you're still paying it, because there's a point where you don't have to anymore, it's still just $200. Okay, I don't know about you, but that's an awesome guarantee to count on. It's not forever going to go up. The death benefit, we understand this to be the amount of money that's paid out upon death. Okay, just like the cash values, this also grows in a whole life properly structured policy. The cash value said it also grows over the life of the policy and is also guaranteed. And then these policies are based on age, gender, and health. Obviously, the younger and healthier you are, the cheaper it is. And then there's something called dividends. People understand dividends, right? It's like profit sharing for most companies. When the company's profitable, they pay a quarterly or annual dividend, right? Back to the shareholders who are effectively the owners of the company. With mutual companies, whole life companies, there are no shareholders. The policy owners themselves get these dividends paid back annually into your policy. So that's what delivers that guaranteed growth. And then this last part, paid up additions, we call it in the industry PUA. Okay, this is extra insurance that's bought without extra expensive or underwriting. This is like the extra fuel on that rocket booster that's hyper efficient, okay, and will return you a tremendous amount of return on your death benefit and on your cash value. Okay, so whole life is supported by what I think are four pillars, right? I use pillars because they're strong, they support the system or the cash flow system. The first one is that you can use these to rapidly pay down debt, okay? Like we said about the airplane example, you can turn the wind current that was once a headwind into a tailwind behind you. Think about that. Instead of paying all this interest, you have the interest going into your policy, supporting your financial aim and your security. The second one is that there's continuous and uninterrupted growth. Remember these guarantees? The power of compound interest. They joke it's the eighth wonder of the world, right? It's amazing. Um, think of the rule of 72. So quickly, you take 72, whatever your interest rate, if it's 8%, all you do is divide 8 into 72, you get 9. It takes 9 years at 8% to double your money. Conversely, if you increase it to 9 years, it'll just take you to 9%, it'll take you just 8 years. Okay. And then pillar 3, liquid. It's free use of your money. Okay. Understand when you borrow money, or actually when you buy those CDs or, put it into the IRA, it's not liquid. That money's locked up for that time period. In the case of a CD, if it's a 24-month CD, guess what? You can't use it for 24 months. You're waiting while it grows, but it's locked up. Same with your, insurance or your retirement accounts. Okay, that money's locked up. But with your life insurance policies, these are liquid. The cash value is for you to use, free to borrow out and to repay as you please. There's no fixed payment schedule like a car loan or a mortgage. It's flexible, and you suffer a bad patch for 6 months or so. If you don't make your policy loan payment, that's fine. It's even if you can only just afford the interest, that's fine. That's the flexibility of the policy loan, the free use of your money. And the last one, which is huge, is the tax-free wealth transfer of the death benefit to your heirs. Okay, if you have $1 million death benefit when you graduate off this earth, it's simply a check that's written to whoever you designated as your beneficiary. There's no probate fees, estate taxes, no realtors to pay, no attorneys to get their cut. And if you have 3 kids, you can easily divide 3 into any number, much simpler than you can divide a big house into 3 people, right? So you have to appreciate that. Now, how do you use these policies? How does it work, right? Remember, it's a cash flow system. And ultimately, you want to finance all your purchases using your own bank, right? If you have to finance using a bank, wouldn't you want that bank to be yours? Okay. That also means recapturing every dollar of interest that you used to pay out, that used to pay out of your system and be gone forever. Here, you recapture each dollar and you get to use it twice or 3 times even. The death benefit and the cash value grows continuously and tax-free. Okay. And once you've capitalized your policy, eventually your dividends begin to pay for the policy itself if you want, right? Remember, because it's guaranteed, the dividends also grow because it's based on a percentage of that total policy size. Eventually, your dividends will catch up to and cover your premiums. Remember, because your premiums are regular, they'll never increase, but your dividends tend to every year. Also, because it's self-funding, you may no longer have to even pay any more premium if you don't want to once it's capitalized. Bottom line, the more you use it through these policy loans, the faster it grows. Just like that water example. The more you irrigate your fields, the faster your crops grow. It's the same concept here with the policies. Every dollar extra that you put in the PUA, the paid up addition, will return you over 3 times its value in the death benefit immediately. And then even more than the same dollar that's returned in cash value that you can use immediately, okay, once it's capitalized. So let's break it down into a real life scenario here. Let's buy a car, right? Most people know 3 ways that they can, choose to purchase a vehicle or to use a vehicle, right? Lease, all right? That's the first way. And you don't buy a car, obviously, when you lease it, but think of that as just renting the car. There's no equity stake in the vehicle. Every month you're making that payment, every penny's gone, right? Um, and then by the end of the lease term, you have no car. You all that money's gone. That's the most expensive way. And our example is going to be over a 44-year time period, okay, with an assumption that every 4 years you trade up for a newer, car or new car. The lease is the most expensive way. The second way is through the bank, all right, or the financing company at the dealership, GMAC financing. You can take a loan for the car, right? That's what you do. And you make monthly payments to pay down that car loan. However, at the end, after paying the principal and interest, right, you do at least have the free value of the car. And then over the 44-year time period, because you can trade it in, for the next car, there is a savings compared to the lease, so that the bank, okay, the bank financing way is a little bit less expensive, but it's still in the negative, right? The third way, by saving up for and dropping cash for each car, okay, this is what's called the sinking fund method, where you got to capitalize it, right, by saving up that money either in a savings account or under your mattress. And then by the time you got that $20,000 or whatever you want to buy that Camry, you go right ahead, put that money order in, or check, and then you have the car. That's great. And for most people, 95% of people, those are the 3 only ways that they know of. There is another way. Okay, remember the bank and their handy CDs, our fictitious 4% CD, right? You could effectively purchase, CDs and then pull it out of that to buy the car. Now, the other way is the IBC way we'll look at. Okay, both the CD and the IBC way are good in that they're green and actually will return you your money for the purchases of those cars. But let's break it down specifically between the 2 better ways, the CD way and the IBC way. All right, we're gonna have 2 fictitious sisters. All right, they're identical. They both want cars. They both have the same amount of money. But one sister goes to the bank and they're gonna go and buy the CDs. All right. What they have to do, though, for the first 7 years is take $5,000 and deposit it into their respective methods. Okay. The CD sister drops $5,000 a year for 7 years into these 4% net after taxes CDs. And again, I challenge you to find a CD that pays 4%. That's a little bit, you know, optimistic in my opinion. But for the sake of example, let's go with that. All right. So after 7 years, the sister has $41,000 in her CDs that she can borrow. In this case, $10,550. Okay, to buy maybe a used car. Who knows? But she dutifully pays back that $10,550 in year 8 all the way through year 12 by putting $3,330 paid back to, guess what? Buy more CDs. So she does that while the IBC sister from year 1 through year 7 also deposited $5,000. But instead of buying CDs, she put it into her IBC policy. Okay, after 7 years, she has $35,960. Okay, not quite as much as CD sister, but certainly enough to borrow that $10,550, which she does. You know, and she also takes that $3,030 and pays that back every year subsequent into her policy. Now let's jump ahead to year 15, okay? Before the purchase of the third car, All right, 15 years into it. CD Sisters got 58,464 to work with. But what do you notice? It's IBC Sister. Now she's got 59,570. She's just past her CD sister. Okay. And what's really interesting is that every year after that, her increase is actually more and more than the CD sisters. So what do I mean? Let's jump into the future, doing the exact same thing um, at year 51. All right, we're talking after 11 cars or 10 cars. The CD sister, wow, look at that. She's got $258,927, just over $250,000 CD sisters gotten in the bank and the use of 11 cars. Okay, that's awesome, right? But hey, let's see how IBC sister's doing. To the right, she also got the same use of the 11 cars. She also paid back to the same, penny, just the $3,030. But whoa, her cash value is 964,638. That's short of $1 million. $1 million versus $250,000. Which would you rather have? Okay. But wait, it doesn't just end there. Because they're at retirement, they decide, hey, you know what? I need an extra $50,000 to boost my Social Security. Great. CD sister can do that, right? So she does. She takes at year 52, you see that $50,000 negative out of her CDs. So she's left with 217. Then the next year, 173, then 128, then 82. Hey, what happened at year 57? She's down to zero. And that was after only taking 33,375, all that was left. By year 57, she has drained her CDs out of her account. Oh, but wait, IBC's sister did the same thing. She also took out $50,000 a year from years 52 to 57. Let's see how she's held up. Out of her 964, she still has $1,030,000. Why? How is that possible? Wait a second. Not only did it not go down, but if you note, it actually went up. Remember the dividends? Those dividends continually were reinvested into her policy, which grew tax free, which is not the case with the CD. The CD ultimately depleted by year 57. By year 64, she's still pulling out $50,000, IBC sister, comfortably. Why? Because she still got over $1 million in her cash value at that point. Look at year 64. She's taken out so much more money than CD sister and still has $1 million left, whereas CD sister is probably eating cat food or something if she's still alive at that point. But point is, okay, there's no comparison over the long term between the CD sister's way of financing vehicles, which again blows out of the water the cash savings way, or certainly leasing or financing it from the bank. But the IBC sisters method is just, it's phenomenal. There's no contest. And trust me when I tell you, this is just in the purchase of a cheap, $10,550 car. Imagine if she had leveraged this to, starting a new business every, each time, or buying another property like, a condo, or, single family rentals. Okay. That money you can use for anything. It's not just to buy a fancy Ford Focus. Okay. Um, Imagine you're paying for your kids' education. You're buying, these new rental properties. You're starting another business. All the while, your cash values are growing tax free. Okay. Um, this slide doesn't even mention the fact that, remember, there's a death benefit attached to all of this. And it actually works out to about $1.3 million. Okay. That when she dies, her heirs will get to the penny via check, no taxes. How awesome is that? Okay. I'm going to leave you at that for today. Um, if you want to learn more, you certainly should. I urge you, get hold of these books. Okay, the first one, Becoming Your Own Banker. Remember, that was the Black Little Bible of IBC, written by Nelson Nash. Or The Case for IBC, okay, by Carlos Lara, Robert Murphy. And then this is another favorite of mine, A Path to Financial Peace of Mind. Okay, this was written quite a few years after the Becoming Your Own Banker book. But this is really written in context of, the IRAs, retirement funds, and other vehicles that are out there that you can get a better idea of how to compare IBC against. Two websites, I urge you to bookmark and to read through: lifesuccesslegacy.com. These guys, Mike Everett and Chris Bay, they're my personal coaches, and they helped me set up my policies to a fantastic, result. And then my own website, I got a shout out again on facebook.com, Legacy Wealth Coach. You'll find me there and my wife Pay. We drop all kinds of videos of, financial knowledge, and we try to peel back that curtain, make things less confusing and hopefully more powerful for you, because knowledge is power. Last, I want to urge you all, anyone in the Houston area, to make sure that on November 2nd, we are hosting our first um, IBC Bootcamp, okay? November 2nd at our location in Sugar Land, Texas, from 10 a.m. to 3 p.m. Learn all you want and ask any question about IBC. The men, the legend, they're going to be here. You'll get to meet me in person. See how IBC can work for your situation, because I'm telling you guys, it's the most powerful thing in the financial world today. It's like a secret that, just I can't keep to myself. So anyways, thanks a lot for listening in today. It was a lot of fun. Uh, Click on that link for the invite and do sign up if you can for that boot camp. Otherwise, get yourselves copies of these books, start reading, and start asking questions and learning out more for yourself. Until next time, have a great one. This is Mike, your Legacy Wealth Coach, signing off. Bye-bye.